Sydney, welcome to my podcast. So happy to have you on here. I know we connected very briefly at ID Nation, and it's really great that we could make the time to organize this.
No, thank you for having me. Very excited to be here and chat all things M&A.
I'll share this with you. There was more than one occasion where when I was talking to an MSP about various options, and Evergreen came up a bunch of times. So whatever it is that you guys are doing, I think you're doing it well. So congratulations for that. There is, however, I think a reasonable amount of room for people to continue to learn more about your platform and about what you do. So give us a bit of a background on Evergreen's platform strategy and what role you play in that.
Sure. Well, first of all, glad to hear that. It means my team is doing their job well. So I always appreciate that feedback. Best case is everybody at least has heard of us. But I do appreciate you saying that. Yeah, maybe to back up a little bit on Evergreen and myself personally, I've been with Evergreen for just over 5 years now. I am our VP of M&A, so broadly oversee all of our MSP M&A across our kind of 5 geographies that we operate in. We've been focusing on MSPs really since the inception of Evergreen. We do have a couple of areas where we invest today, but MSPs continues to be kind of the largest component of that. And really, the way we got into that space is when Evergreen was started, the impetus behind creating it was a desire to invest on a much longer term time horizon than your typical private equity models of buying a business and selling them off in a couple of years. So we actually spun out of a larger PE firm, Alpine Investors, who is still our capital backer today, and really said, we want to invest on a long-term time horizon. And when we say long-term, what we mean is that we're never selling the businesses that we buy. We operate as a holding company, and the mission is really to be a permanent home for the companies, the leaders, the people that come along with them. As we think about industries that make sense for us to invest in, it needs to be ones that are going to be around for the long term. And so that means, recession resistant businesses, durable business models, predictable revenue streams, kind of adaptable service offerings that as technology in the world inevitably changes, kind of keeps up with that. And I think MSPs fits all of those things really to a T. It's honestly been a hard industry to replicate in any way, shape, or form. And so we've continued to be more excited about the space every year that we've grown. Fast forward from 2017 to today, we've acquired just about 90 MSPs across the US, Canada, UK, and then Australia, New Zealand. Some of that international expansion has been more recent, but an exciting kind of global piece of the business now. Obviously, a really high volume of businesses that we've acquired over 6 or 7 years. Part of the reason we've been able to do that is kind of the other core tenet of our model, and that's our decentralized operations. And I think this is where a lot of questions tend to come up, very different than a lot of the other models you see. When I say decentralized, what I mean is that we do not integrate and roll up our businesses. So we retain the brands, the teams, the people, all of the things that have made an MSP unique, we want to keep in place. We think there's a lot of brand equity that's been built, the relationships that techs have with customers, the presence that these businesses generally have in their local communities are all reasons they've been successful. And so we don't want to destroy, what's not broken in our view. And so we leave the day-to-day of each business fairly independent, but we have a high level kind of umbrella operating team that sits over all of our MSPs, and they're called Lyra Technology Group. Lyra itself is not an MSP, but really their role is to be the connective tissue between the businesses. And also I think of them like a centralized support resource. So they're doing things like negotiating with vendors for better purchasing power. So if you're using, a piece of technology that we have an agreement with, you can opt into that master contract and get generally more favorable pricing. They are helping build out, their role is really to help facilitate the organic growth of our businesses. So whether that's hiring the right sales and marketing people, whether that's building that function from the ground up, whether that's helping professionalize contracts, build in price increases. I think every business has different pain points. And so this suite of resources that can help solve those individual ones from the businesses. The people team helps with recruiting from executive to the technical level and so on and so forth. And then really facilitating the community between the companies. Where can we cross-sell, resource share, knowledge share? So it's kind of Evergreen in a nutshell. I just talked for a lot of time.
No, but there was a lot of great information in there. So let's take some simple examples. You said that the companies maintain their branding. So if someone is sending an email, post acquisition to their client, is that email to the client? Does that email look like it's coming from them, the original people, or does it look like it's coming from Evergreen?
Coming from the original brand, the original business, the polos they wear to work have, the original logo on it. They're not seeing anything around Evergreen, certainly, and not Lyra as well. And that's intentional, right? Our view is, if you didn't tell anybody that you sold to us, in the first 6 months, that they shouldn't know outside of, some of the finance and other pieces that are a requirement. But in terms of the day-to-day and the customer interaction, we are not getting into that.
Yeah. And, you talked about Lyra as a competency effectively for these, companies to tap into, to be able to get better deals on the pricing of various tools and software and things like that. What about the aspect of them as a community being able to share each other's learnings and things like that? Do you do that at Evergreen?
Yeah, that's a really big part of it. And I almost think of Lyra as a peer group in and of itself. We have a lot of businesses that continue to stay in their respective peer groups, which we think is great, but then also having, what comes through Lyra. And so I think there's the Lyra community as a whole that gets together twice a year at, kind of conference-like events. And then part of the Lyra team is what we call our regional CEOs. So obviously with 90 businesses, it's a lot to be reporting into one person, one entity. And so a component of that team is the regional CEOs. We've got 8 or 9 regions, and each regional CEO oversees kind of 5 to 10 businesses. They're really that accountability partner for each of the on-the-ground leaders, the connection to the broader Lyra team. They're touching base, minimum monthly on performance tracking, budget building and attainment. Where are you having pain points, and how can we help solve them with the Lyra resources? And I think it's kind of a best of both worlds situations in my view. I think what I hear a lot of founders say is that, being a CEO is lonely, but you also don't want to give up the reins of controlling your day-to-day. And so within our model, you still have autonomy over the day-to-day of your business, but you have this partner in the regional CEO at Lyra. And I think the other exciting piece is that half of our regional CEOs are actually former sellers who have sold to us, done really well, wanted to take on a larger role, and kind of stepped into that bigger leadership role, which has been exciting to see.
Yep, that I can tell you that there are several founders to whom that will be a very appealing point, that they get to kind of move ahead on in their career to like a bigger role, and maybe and play that strategy role, pick up those skills in their career. So I think that's great. There are other people who do this, right? Maybe not exactly like you guys do it, but certainly they do less integration, right? And they allow companies to be as they are. What do you think, if there's one thing you want someone to keep in mind in terms of what differentiates your model, what do you think is something that's worth remembering and keeping in mind about that?
Yeah, I think there's 2 things. One is the hold forever component. I haven't come across anyone else in the space that's taking that approach. And why that's important is because ultimately, whether you integrate, whether you don't integrate, whether you semi-integrate, if you are coming up on a time where whoever is backing you is going to sell the entity, that's going to change your behaviors in the near term. There are certain numbers and performance metrics that you're going to have to hit. And sometimes there are near-term and long-term trade-offs that you make to be able to make that possible. And so we have a much longer term view that's, perhaps slower growth in the immediate term, because we're not, centralizing all these costs that immediately drop to the bottom line, but more sustainable as we think about, okay, we're still going to own these businesses in 15 years. Will they still be growing double digit organically then? So I think that's a key difference. I think the other piece about us, and this does vary acquirer by acquirer, but is our talent model. So we have a lot of flexibility around founders, whether they want to stay or leave. And ultimately we want to solve for their objectives. We do like to place talent in every one of our businesses. And I think that's a huge value add that we bring to the table. We have access to different talent than I think, an individual business owner would have. And so obviously if someone's transitioning out, we need to backfill that CEO role. And we've done that many times. oftentimes someone's staying, but it's been a principal-led sales organization for the last 25 years. How do we place a CRO, VP of growth type role in there that's really going to elevate the growth of that business? Someone that wakes up every day and thinks about, new logos, new business. And I think long-term view is those people are the succession plan for founders that want to stay for now, but not forever. So I think that piece is fairly different as well in terms of how we think about, management staying or going and back.
I do believe that you offer various different pieces in the compensation packet, depending upon the structure and the circumstances, be it cash, be it roll-up equity, be it earnouts. There has been a question about, well, if you hold this forever, then how are you gonna, cash out of your equity position? At what point? How does that get monetized?
Yeah, really good question. And that would be my first question too. So ultimately, as we think about liquidity for, sellers that have rolled equity into Evergreen, we will buy back shares at any point. We're marked quarterly at our valuation. So at any point you say, I'm ready to liquidate some or all of my holdings, we'll work through the process of buying back those shares at market value. So we have kind of an ongoing buyback program, and that's the most immediate form of liquidity, which I actually think is a bit unique in that we aren't only waiting for certain time periods to be able to offer liquidity to sellers. We also will, we obviously have limited partners and, back end financing that needs to see a return on their investment down the line. They've backed us to be a long-term model, but as we head towards kind of the end of the 2020s, probably we'll be thinking about a larger liquidity event, and really the purpose behind that, outside of getting people their liquidity in a more formal event, is that we want to, while Alpine has backed us on a long-term hold model, ultimately we will transition into a more truly permanent capital model. And there's a couple ways that could happen. IPO is a big option, as well as family offices and other capital partners that do not have a need to liquidate in 5-7 years. So there will be a larger liquidity event along those lines down the line in a couple of years, but that does not I hesitate to say that a little bit, because I think the reality is, if you put equity in Evergreen, you can always liquidate at fair market value, and people have done that in the past.
Okay, got it. Let's talk a little bit about the size of transaction that you're looking to do. Do you have a threshold? If so, what it is, and when might you ignore it?
Yeah. So we'll actually look a little bit lower than that. Our kind of minimum size threshold is $500,000 of EBITDA and $3 million of revenue. And I think both of those things are important, because you can see $1 million revenue businesses with $500,000 of EBITDA when it's just one or two people. And that's not the right fit for us. If you think about our model, right, it needs to be a business that can stand alone, in theory, with or without the founder. And so I would say that's our size threshold, and we would like to see at least 50% of the revenue be recurring, which is generally table stakes for a true MSP. And so those are kind of what I call our tripwire criteria. As we think about $500,000 of EBITDA, though, I think it's important to understand that that's kind of fully adjusted, meaning there's compensation running through there for a leader of the business. The business has $500,000 of EBITDA when it's set up to stand. Where do we send that out the window? Not very often, to be perfectly honest, because of our decentralized model. It is important that there's kind of that baseline level of scale and maturity. On occasion, there have been times where more of a tuck-in opportunity does make sense, whether it be a specific capability, a geography, a really good culture match. And, we certainly have the flexibility and desire to pursue those as they come up, but it's not kind of our core model.
Mm-hmm. What are some key financial metrics that you really look for, in deciding either to say, no, we're not going to look at this transaction because of sort of not having that quality about it, or yeah, this is great because it has that quality about it? Are there some things like that are in your bucket?
Definitely. I think kind of running down our investment scorecard in my head, some of the things that we think about are growth of the business, and where's that growth coming from? Are your monthly recurring lines growing, or just product sales growing? And customers is a big bucket. And I think there's really three key components of customers that we look at. One is customer concentration. Do you have significant portions of revenue coming from specific customers? That's a huge risk for a buyer. Generally those customers are also tied to the founder from a relationship standpoint, which makes sense. But if you think about a founder leaving, this customer makes up 25% of revenue. They're very personally tied. It's a risk area for the buyer. So when there is concentration, it can sometimes be a deal killer, but we're also going to dig into what the contract looks like. If somebody's making up 25% of your revenue and they're on a month-to-month contract, that's going to be pretty tough for us to get comfortable with. If they're on a 3-year contract, that's a different story. I think the next component is retention. We spend a lot of time in due diligence looking at both customer and revenue retention, and they are two different things, right? Because you could be retaining all really small customers, and ultimately, your revenue retention is actually pretty poor because you're shedding larger customers that are significant portions of revenue. So we look at both, and I think customer retention is a really important KPIs as you think about the business and the health of the business, and particularly the net revenue retention. And so what that number is looking at is, of the revenue you had last year, how much of that do you have this year, and how has it grown? And so most of our businesses have net revenue retention of above 100%, meaning that even if they were to not add a single new logo in a year, they're still growing the business. And that's an important baseline. And I think that leads into kind of the third bucket that we look at with customers, which is the new logo engine. Is there one? Who's leading that? Is it all referrals? Is there dedicated sales? Kind of what does that look like in the business? And I think that this area probably has the biggest disparity across MSPs. And I think it's a pain point is kind of finding the right salespeople and getting that out of the founder's hands. And we recognize that. And again, something we help with through our talent placement. And so I think the customer bucket is a big one. I think a sort of less quantitative piece is like the operational maturity. And there's a lot of things out there in this industry with, sleek and operational maturity. And I think those are all great benchmarking things, but we spend a lot of time just in general looking at operational maturity. Is your team running way too hot? The business is running at 35% plus EBITDA margins. Chances are, there's going to need to be hires in the business. Is the founder wearing 7 different hats, or are there different managers with swim lanes? Are the books clean? Can we easily look at the different revenue lines of the business and actually track some of these metrics I'm talking about? So, I think that bucket of slightly more qualitative, is the culture strong, employee NPS is really important as well. So those are some of the top things that come to mind.
I want to ask you about a theme that's pretty hot right now, where smaller MSPs, $350,000 to $500,000 of EBITDA, are saying, I want to scale, and I'm going to scale this by finding myself another MSP to just become larger. What are your thoughts on that? What advice do you want to give to smaller MSPs when they're looking to do this? Most of the time, their argument is, we'll get a higher multiple if we get to a higher scale.
Yeah. How do I phrase this? I think that can make sense for much smaller MSPs that are kind of sub that $500,000 of EBITDA mark. And I think there's a couple of things that are really important to think about if you're merging with someone to kind of get large enough that you are, a fit for most private equity backed buyers. We just talked about it, cultural alignment. I think that's where the biggest misses happen on these. It's hard, but anyone can get through the financial integration and the tech stack integration. What most people don't spend enough time thinking about is the cultural integration, if it's even going to be possible. The other piece is ownership and leadership. You often have 2 leaders, if not more, coming in, and it doesn't work super well to just have a partnership. So there has to be ownership over certain pieces of the business, ultimate decision-making rights. Otherwise, you kind of get stalled. We often see people getting stalled in this in between, where you're sort of partly integrated, but partly not, because you can't come to an agreement on how you want things to look like. Which group's contracts are you taking over? Which brand are you taking over? Like, all of that stuff, I think, is really important to think about ahead of time and make those decisions before you enter into the financial piece. Because it can be hard. And if you have the capacity to have somebody whose whole job is to focus on managing the integration, that can go a really long way. If you are bigger, I think it is a common misconception that if you merge with someone else, you will get a higher multiple and make a better in a sale. Obviously, that 1-for-1 math sounds like it works, but there's so many other factors that make 1 + 1 not equal to there. For all the things I just outlined, they are much, much harder to get right when you're bigger. And so rarely have we seen mergers between equals of a larger size go well. Generally, what happens is the base business and the organic growth suffer really badly. And from a buyer's perspective, that's the first thing we're going to look at. There is a reason that we have 50 people focusing on M&A at Evergreen and 50 people focusing on operations at Lyra, and they are separate teams. It is very hard to do both of those things well at the same time. I think the other reality is that when you combine with somebody else, it doesn't just mean your multiple doubles, right? You may be slightly bigger and therefore, multiples go up a little bit, but it's not this 1-for-1 escalation of the multiple. I think is really important to outline. The other piece to consider is that if it's a true merger, you're then splitting whatever this bigger pot is with somebody else. So does that actually end up being bigger than what your individual sale would be? And then if the business is deteriorating as a result of having to focus on going through this merger, are you actually going to get that increased multiple, or has the quality gone down? So in some cases it has gone well. It can yield to more money, but I feel that there's not enough discussion around how often it goes wrong.
Coming back to your transactions from a timing standpoint, from the time that you see a sim to the time that you close, are you willing to share an average timeline for how long it takes and what that feels like to a seller?
Yeah. So we typically do a 60-day diligence, give or take. We like to close on the first of the month. From an accounting perspective, it makes the seller's lives a lot easier, as well as our accounting team. But generally 60 days is the right average. We've done 30-day diligences. We'll happily have you talk to the people that went through it. Don't know that I'd recommend it. And we've done a little longer, but I think 60 days is the right average, that we're pushing the pace the whole time, but not kind of burning out everybody involved too far. Diligence is really hard. It's a lot of work. It depends on the state of your books and your data, but I think there's kind of 4 key components for us that happen over those 60 days. The first is kind of an evergreen data dump, working with our team. We'll do a longer form meeting, generally in person, to really get to know the business, the customers, the history, the revenue lines, all of it. The quality of earnings is kind of the first, what I would call, gating factor in the deal. So this is the financial diligence, where we're effectively validating the number we've said in an LOI. This is what we think the revenue and EBITDA of the business are. And as such, this is the value that we're placing on the business. Now, through financial diligence, we're going to make sure those numbers are true. And so taking a really comprehensive view of the past, present, and future of the business. And I think that is kind of the big stopgap of, that number comes out in line with what you expected, which hopefully it generally does. Generally smooth sailing going forward, or there's, a harder conversation to be had. Thirdly would be customer diligence. So we do customer diligence on kind of top 15 to 20 customers. We use a third-party provider. So Evergreen, Lyra is not talking to your customers. There's no mention of a deal, but rather, we have you reach out and say you're running kind of a verbal customer NPS survey. That's all data that we share with you as well. And so you can use that going forward, but a really important part of the process. And then the fourth component would be tax and legal. Which by that point is, getting through all the red line with the lawyers, but in terms of the business diligence, is fairly complete at that stage.
How do you see this MSP market evolving? How does that influence your acquisition strategy? Are there emerging trends with respect to things like cybersecurity or cloud or AI that you're particularly focused on, that you think are going to have just a sea-changing impact on this business?
Yes, is the short answer. I think the industry is going to change a lot in the next 5 to 10 years. Even as I think about our first 7 years in the space, I feel like we entered while some of the transition from more T&M and break fix work to managed services was happening, and that's obviously been transformational. I think the next bit has been, and this is ongoing, but the shift from private cloud and infrastructure heavy businesses to the public hyperscalers. And I think the security uptick is again kind of it's a table stakes now, but that's been a big growth area for a lot of our businesses. As we think about the next 5 to 10 years, I think all of those are ongoing components, but the next really big thing is the AI and automation piece. And it's going to change the way that MSPs do their business. It's going to change the day-to-day jobs of the people in the business. I don't know that it will ever fully remove the people aspect. I think about calling my bank, and I hate when I can't talk to an actual person, but do I like that they can automate parts of it? 100%. So no, I think that metaphor applies here. But I think that MSPs that aren't open to that change will fall behind. So as we think about our acquisition strategy over the next couple of years, we're not only acquiring businesses that, are very far ahead on the AI and automation front. I think that's exciting. I think there can also be some benefit to, seeing what happens a little bit, but being open to it. But we are spending a lot of time looking at businesses that are, because we want to understand sort of what that's going to look like, how that can impact the business. And there's 10, 20,000 MSPs in the US. The ones that do really well are an irreplaceable advisor to their customers. So they're not just answering the phone when somebody's laptop is broken. They're also helping define how technology is going to change how their customer works. And so taking that more proactive, consultative mindset is going to be really important.
What is a risk that is underappreciated in this space?
Yeah, I was thinking a lot about this when you gave me this question to prep. And honestly, the first thing that comes to mind is co-managed customers. I feel like, I think back to DattoCon 3 years ago, I think it was. And, Fred was talking all about how co-managed is the future of the industry. And I think it is in a lot of ways. Like, I don't disagree that it's a huge component of the industry, but I think there's some really important nuances there that particularly are a risk as you think about wanting to sell your business. And we've seen it come up a lot more and more in businesses that we've looked at. Co-managed customers are just like 100% higher churn risk in a lot of cases than a fully managed customer. For all the things I just talked about around being that important technology advisor, you just aren't that in a lot of cases in a co-managed relationship because they have other providers, they have internal IT, whatever it is. They may also have leadership that's changing more frequently, other private equity backers that are, dictating their IT spend. So I think that we've started to dig a lot more into what does the nature of the co-managed relationship look like. If you are just selling products, be it recurring or non-recurring to these customers, that's fairly commoditized, and they can pretty easily go get that somewhere else. I think the co-managed relationships that are interesting are, say, you do the full security posture for the business. So maybe they have their own level 1 help desk doing the day-to-day IT, but you take all level 2, level 3, and are their security advisor. That's a lot more sticky, and you're adding really substantial value to the customer. Now, also got to get those customers on longer term contracts, which can be really hard because bigger businesses don't want to sign up for long-term spend. But I think it's this tough catch-22 because, it's just a huge risk for buyers. And I feel like it does not get talked about enough, how risky co-managed customers are. And more importantly, what co-managed customers are good and what co-managed customers are scary. So that's something that, I've been spending a lot of time thinking about recently. And, we didn't used to dig in too much. And I think we've had some good experiences and bad experiences with that. And now we spend a lot of time on it.
Are there aspects of the MSA in terms of features that it has that you think about consciously when you're thinking about valuation? I'll throw out a few just to kind of set the idea here. So, not every MSA, you talked to us about something about monthly frequency versus annual or 3-year frequency. That's one area. And does this MSA have price accelerators automatically built into it, or does not have any price accelerators built into it? Are there termination fees associated with clients, in their MSAs that might give clients a pause before they go somewhere else? Placement fees in case they lose their own employees to customers because the customer industry loves them. There are so many aspects of MSA language, and I wonder whether people think about those pieces when it comes to, hey, what does this mean for the value of my business when I sell it? What is your thought about that?
We partner with a ton of businesses that do month-to-month contracts. I don't inherently view that as a huge problem. It becomes a bigger problem when there's customer concentration because the risk just escalates very, very quickly. So I think as we think about, what is a best-in-class contract, ideally an annual managed services contract. And if you have an annual managed services contract with no payout clauses and 30-day termination, that's a month-to-month contract.
Right.
So I think we see that a lot. So annual contract, ideally a 90-day termination clause, you pay out the remainder of the contract if you terminate, and regular price increases tied to CPI or greater, I think are kind of the four buckets of, this is our ideal best-in-class contract. If you have customer concentration, 36 months would be preferable. So we have that revenue visibility. So that is ideal. We work with a lot of our businesses to get that in place. Most do not have that when we look at them initially, and it's not something that we're dinging people on valuation for. Again, concentration aside, like I guess I very much understand why founders have not put those in place from a relationship standpoint, and honestly, from keeping the team accountable to providing high quality service. But as you think about sort of maturing into a professional organization, I do think it's an important thing to think about.
Mm-hmm. Yeah, I appreciate that. What are some of the biggest challenges in the MSP acquisition space, and how is Evergreen addressing them? Is it talent retention? Is it customer retention? Managing the complexity of an evergreen portfolio of acquisitions? What do you think is
I think that we probably face different issues than most acquirers. We have very high employee and customer retention due to our decentralized model. But our biggest challenge, I think we do well at it, but that we work every second of every day on, is organic growth. It is not easy to grow businesses double digit organically, and there's a lot of things that have to go right for that to happen. And so, we're thinking about that day in and day out. And while we've built a business based on doing M&A, I would say that organic growth is the single most important thing that we do. There is no value in our business and all the businesses we've acquired if they don't grow. Yeah. So it seems basic, but it is. I think as we think about the day-to-day of our businesses, and I think it's getting harder and harder. I think across the industry, we've seen much higher customer churn than normal this year. And so, new logos are being added, but customers are churning because there's so much M&A happening in other industries as well. That's driving a lot of that churn. That it's steps forward, one step back, which it's tough.
In the next couple of years, right, several PE-backed MSP platforms are probably going to be coming to the market, right? What will you be looking at when that happens?
Yeah, they definitely are, and I think already are. I mean, very basically, they are important data points for our value as well. What those transactions trade at. I think it will also be interesting to see a lot of these other buyers had huge equity components for sellers. So it was a requirement to roll a not insignificant portion of equity into the business. And I think it'll be interesting to see if the returns that were outlined do come true. It will also be interesting to see who they sell to. So, we saw Intiva and Purple Guys. Are there more mergers like that then continue on the path? Do they sell to bigger and bigger private equity firms? I think it will change the lineup of who the different buyer options are in the space and the strategies that they're approaching. Do some buy, an MSP roll up and then try and take it more mid-market enterprise focus. We've seen that happen in other markets versus kind of SMB focus. So I think there's a couple of components that'll be interesting to watch, but it's just important for demonstrating the value across the space and for sellers that have put their faith in a lot of equity in businesses.
Yeah, like a proof of concept. Yeah. So like, did this actually work the way we wanted it to work? Sydney, thank you so much for your time. I really appreciate your talking at length about your model, about what you're looking for in terms of value, your big picture views. I really appreciate it. I hope we can continue to maintain a relationship and meet each other in conferences and talk a lot about how this space is going to evolve. I'm also very excited to see what's going to happen with these exits.
Absolutely. No, thank you so much for having me. Fun conversation on a Friday morning. So
yes, that's right. That's what
stuff.
Absolutely. We should do another one of these in the not too distant future.
Would love to.